For those of you unfamiliar with MSI, we're an independent shipping and offshore market research company with offices in London and Singapore. We were established over 35 years ago with a principal focus on quantitative modeling to capture and evaluate shipping market dynamics and risks. Our established market models, now hosted on our online platform, MSI Horizon, are maintained by a team of sector market experts and enable us to quantify the impact on ship earnings and values of key fundamental demand and supply drivers across all shipping and offshore sectors. We have a particular focus on forecasting. Historically, our work has focused on the impact of demand and supply drivers, such as economic growth, commodity prices, new mining developments, refinery capacity, government policy, new ship contracting, etc., on ship earnings and values. More recently, we've extended our forecasts to 2050 to enable us to quantitatively explore the enormous shifts expected in energy markets and in shipping's response to increasingly tighter environmental regulations. In particular, policies being implemented to reduce shipping's carbon emissions. In this presentation, I'll take you through MSI's approach to modeling dual-fuel ship earnings and values and finish with an example comparison of investment performance by dual-fuel type. But first, I'll provide a brief summary update on some headline dynamics for individual shipping and offshore sectors. Starting with demand. 2023 has been a better year for underlying trade for almost all sectors, with a notable exception of car carriers and crude oil tankers. Indeed, 2023's cargo growth has exceeded the long-term average for 6 out of 8 sectors shown in this chart. Trade in recent years, though, has been volatile, and in some cases, 2023's growth is helping to claw back lost ground. Fleet growth, meanwhile, has also been more manageable in many cases, mostly down to a slowdown in ship deliveries, partly linked to a period of low contracting. However, there are clear exceptions in the case of container ships and gas carriers. Indeed, container ships and gas carriers now have to contend with significant order books, as do car carriers. In the case of LNG carriers, and to a lesser degree container ships, this will lead to rapid fleet expansion, since the age of the fleet on the water is also so young. This data, though, needs to be taken into context against expectations for demand. In one illustrative example, the order book for dry bulk carriers has fallen to a long-term low at just below 10% of the fleet. But some key dry bulk commodities are under threat from structural shifts in market dynamics, partly linked to the world's move away from carbon-intensive energy and industrial metal production. In a world where demand growth is flat, and assuming ships take 2 years to build from point of contract and last on average 25 years, then an order book of 8% is enough to maintain the status quo, with anything higher than this potentially signalling downside risks to market balances. On the rollercoaster of ship earnings cycles, some sectors have enjoyed significant upswings recently, such as oil tankers and car carriers, whilst MSI expects further gains for offshore markets. Others have had a more disappointing year, notably container ships and dry bulk. A word of caution from our analysts: whilst these two sectors are approaching an ebb in their respective market cycles, turning the corner to more positive times ahead could still be many months away. To provide some context for my discussion on dual-fuel earnings and values, I'll provide a quick update on the adoption of dual-fuel engines. We've touched on this already, but in July, the IMO updated its initial strategy on greenhouse gas emissions set in 2018. The main outcome was an ambition to reach net zero greenhouse gas emissions by or around 2050, with new indicative checkpoints in 2030 and 2040. How will these ambitions be met? Certainly, changes can be made to the existing fleet to reduce emissions, including operational measures to improve fuel efficiency, like slower speeds. Some lower-cost fuel-saving technologies will help, and the potential of carbon capture is being explored. However, it is widely expected that alternative low- or zero-carbon fuels will form the backbone of the industry's response to meeting a net zero target by 2050. The introduction of dual-fuel vessels and replacement of the conventional oil-fueled fleet will take time. Alternative fuels are expensive when compared with conventional in terms of the installation of technology as well as the cost of the fuels themselves. Broadly speaking, MSI expects a cascading effect as the fleet develops, where leading ship owners will be the first to commit to new technologies as they emerge, and in some cases, passing on these ships with older technologies in the process to other tiers of owners. But the relative size of the LNG, methanol, and ammonia or other fueled fleets will depend on the pace of technological development and fuel supply on one hand, and the pace of regulation on the other. Looking at new ship contracting over the past 18 months, we can see that dual-fuel technologies are already being readily adopted by some sectors, such as container ships and car carriers, whereas others are taking a little longer, despite some striking headline news. Even if all new ships ordered from now were dual-fuel, it would take many years to replace the existing conventional fleet. In order to understand these dynamics, MSI's market model has been updated to account for contracting of different fuel types for each and every sector and subsegment. The selection of fuel type is driven by various factors covering technology, economics, and regulations. This is a forecast subject to significant change. MSI currently expects the share of dual-fuel ships to gather pace in the 2030s and for methanol to take a leading share before a hydrogen-based fuel like ammonia makes inroads into the 2040s. Would that be enough to meet a net zero target? Our base case suggests that the initial target set in the IMO's 2018 initial greenhouse gas strategy would be met, but not the updated net zero ambition. Only if additional measures, such as carbon capture and storage, or increased use of biofuels are used for the remaining conventional ships in operation, would a net zero target be met. Nonetheless, dual-fuel vessels will be a critical component in the achievement of shipping's net zero ambitions. What should we expect for the evolution of earnings, values, and return on investment? To answer these questions, MSI has expanded our online ship valuation tool, FMV, to incorporate dual-fuel ships. To start, I'll outline MSI's approach to modelling shipping asset values. A ship's value could be defined as the net present value of expected future cash flows, but earnings are volatile and expectations vary amongst the pool of buyers and sellers. In this case, how do we define what should be an asset's arm's length market value? Without certainty of future earnings, it's no surprise that the cost to replace the asset has an impact on its value, the new build price. Indeed, on many occasions, we have seen the new build price and second-hand tonnage move in one direction, whilst earnings move in another. In MSI's modelling, new build contract prices set a soft ceiling to ship values. Soft because prices of modern tonnage can, in strong markets, exceed new build prices and have a more significant impact on modern tonnage than old. It is reasonable to assume a floor to a ship's value at its scrap price. The shape of the depreciation curve, including the implied age at scrap, is then set by the time charter market. For dual-fuel vessels, we assume the same applies. The problem we face is how to model responsive depreciation curves to time charter markets, since we have no sales to build depreciation curves from. We've approached this hurdle by modelling the relationship between depreciation curves and profitability. This we can do with conventional assets and use the same curves with an estimated profitability for dual-fuel vessels. More on this later. But first, a key step in this process is to estimate dual-fuel new building contract prices. Since MSI maintains a database of reported new build contracts from a range of sources, we're increasingly capturing prices for dual-fuel ships and comparing with equivalent prices for conventional ships to understand the premiums being paid. This is becoming more reliable for LNG dual-fuel and more recently methanol dual-fuel ships. We also incorporate estimates from a range of academic and industry articles and reports. The cost for ammonia dual-fuel, for instance, is mainly drawn from the latter. We now have a database across tanker, bulker, container, and car carriers and are expanding to other sectors. I won't expand on the forecast levels for new building prices presented on the right in this presentation, but the important takeaways are that LNG and ammonia dual-fuel technology is expected to remain expensive when compared with conventional vessels, and methanol slightly less so, although the premiums over conventional will narrow over time. Meanwhile, for scrap prices, we have a marginal premium for dual-fuel ships, but this again may change as new evidence emerges. Perhaps the most crucial cog in this methodology, though, is estimating ship profitability via a calculation for ship earnings. What should define the time charter rate for a dual-fuel vessel? Here, the boundaries are blurred between the intangible and the tangible benefits of a low-carbon footprint and balancing economic rationale with the impact of regulations on potential operational restrictions on conventional vessels. MSI is keeping an open mind. But for now, we model on the basis of quantifiable economic impacts. The assumption we take is that at minimum, dual-fuel ships will be chartered at conventional ship rates, since they can use conventional fuels. We would expect some premium related to fuel optionality, depending on the length of the time charter contract, but this is something kept out of our methodology for now. The main difference emerges when it's cheaper to use alternative fuels than conventional. MSI assumes the dollar premium to charter a dual-fuel ship over conventional will converge at the cost savings for doing so. And here there seems to be some difficulty justifying some types of dual-fuel ships, since the cost of fuel differential is expected to be large. Note the exceptions here. LNG and LPG fuels are anticipated to drop below conventional fuels and be used increasingly over the coming years. But if these fuel price forecasts, which represent something close to a consensus extracted from a review of sources, are reliable, then we will need to see a means to bridge this carbon gap to encourage zero-carbon fuels. Now, this is where opinions really differ. First, on how this carbon gap might be bridged, likely through a mix of taxes and incentives, potentially both regionally and globally. Second, on the level. Estimates vary wildly, and there is no consensus yet. If the method to address the carbon gap, let's call it carbon tax, is to be effective, it needs to be well controlled and reactive to technological developments and innovation, since the cost of low-carbon fuels will be difficult to control. MSI expects the cost of carbon to adjust accordingly. This we'll come back to shortly. However, the cost of fuel and carbon tax is not the only pressure acting on ship charter markets. We also need to consider high operating costs and high capital costs for dual-fuel ships. This illustration helps to explain MSI's methodology behind our time charter rate modelling. Operating costs set a floor during weak markets when the fleet employment rate drops below a level that's typically around 80%, but depends by sector and size. Capital costs act as a positive pressure on time charter negotiations as the market tightens, until the highest capital cost margin for modern vessels are covered. And then in very tight markets, freight earnings start to respond strongly. How do we combine the effects of CapEx, OpEx, fuel and carbon price differentials on the time charter rates for ships with different dual-fuel options? I present a case for three worldviews to help explain. This illustration is assuming only one dual-fuel option, let's say LNG, versus conventional. And the chart represents these three worldviews in a particular point in time, let's say 2030, when LNG fuel costs are lower than conventional bunkers and have the added benefit of less carbon tax. In all three cases, the differential between the charter rate for conventional, the blue bar, and the LNG-fueled vessel, green bar, are the same, based on the fuel and carbon prices at the time. But the three cases have very different levels, based on the level of uptake of LNG dual-fuel vessels. On the left, low uptake view, we have a fleet of conventional ships with just one dual-fuel vessel. The time charter market is set by the conventional ships, according to the OpEx and CapEx pressures of the conventional fleet and the employment rate. And then the dual-fuel LNG vessel earns a premium. On the right, high uptake, almost 90% of the fleet is LNG dual-fuel, and so it's the OpEx and CapEx of these ships, along with the employment rate, that sets the time charter market, with conventional ships now at a discount. Interestingly, despite higher cost pressures, since the differential related to fuel and carbon cost is greater than the cost pressures of OpEx and CapEx, a higher uptake of dual-fuel ships results in lower time charter earnings. This could be very disruptive for the industry. The modelling is complicated by the emergence of several different dual-fuel options, but the theory stands, and MSI's model accounts for the different shares by different fuel types. In a nutshell, time charter rates will be influenced by the share of dual-fuel uptake by fuel type and the associated capital costs and OpEx, as well as fuel and carbon prices. And this we account for in our online platform, MSI Horizon. So one interesting takeaway is that LNG dual fuel ships will be taking advantage over the coming years of lower fuel costs and introduction of carbon prices, and are expected to be chartered at significant premium to conventional, but a high cost of LNG technology is a key barrier and severely limits investment returns for many independent owners. To bring this together, I've run an investment timing analysis for a 5-year-old Cape-size bulker by fuel type through our FMV online ship valuation tool, a 5-year investment in each case. I've run this for 2 carbon price scenarios, as shown in the chart below, investing in each year from 2023 to 2030 and 5 years through to 2050. Purely from the perspective of economics, conventional ships will still make sense until later this decade, when LNG vessels start to gain traction. In the high case, the methanol ships provide the best returns from 2029, and ammonia starts to offer better returns than conventional far later in the outlook. The world, of course, is not quite so simple. Arguably, in an ideal world with no arbitrage, asset values should adjust so the investment returns are equal for all fuel types, since ships of different fuel types are chartered for the same purpose. This approach also doesn't take into account the direct impact of regulation on potential future restrictions of oil-based fuels, fuel availability issues, green corridors, carbon capture, the willingness of freight buyers to pay a premium for green freight, the emergence of other dual fuels like LNG, nuclear, the list goes on. But I hope this presentation has been informative and helped understand some of the drivers MSI is using in our methodology to value and forecast dual fuel ship earnings and prices. Thank you.